Online lending seems perhaps like a broader question. We can get to that a little bit because online lending is obviously something that's not restricted to marketplaces or startups, right? I mean, I think it's actually a bit of a misnomer, and I guess we in the press are maybe guilty of, just in searching for quick ways to refer to things. We say online lenders, but of course, J.P. Morgan and Wells Fargo make loans online too. So I guess maybe let's talk a little bit first about, I guess, the idea of what I think we're really discussing here, which is marketplace lending. And I don't know, somebody tell me if you disagree with that. But I guess maybe I wanted to maybe turn to Nat first, because I think that the MLA, when they came out last year or earlier this year, they actually kind of had a definition of marketplace lending and sort of and said, okay, our members will have, I think, what was it, 70% of the loans will be immediately marked for sale. So I guess maybe let's start off talking about that a little bit and that model. And that is to say, I guess, the idea of a pure marketplace model, or at least one that's heavily tilted in that direction. Have the events of 2016 challenged that meaningfully? Like when we saw, one of the early purist marketplaces, Lending Club, have to put some of its own capital to work when times were lean at some point this year, and I think we've seen other marketplaces, even if they're still technically marketplaces, like they've brought in long-term commitments from other platforms or from other buyers and things like that. So is that really still a marketplace? So I guess maybe let's talk about that. Is a pure marketplace model, is that what needs defending, or has that shown itself to be as strong as ever this year?
I think I could defend a pure marketplace model for a lot of reasons, especially on the public policy front. But I think just the way the Treasury Department has defined it is much broader than that. And I think the way that we at the MLA are now looking at things is to really bring the industry in Washington together. And that includes both marketplace and balance sheet lenders who are making loans below 36% APR. That's kind of a broad definition of marketplace lending to us, because most balance sheet lenders are also eventually making loans available to investors and are not 100% balance sheet lenders. So to us, I think the semantics it's kind of important to dispense with the semantics and focus on building a really credible trade association that can provide some of the standardization and data, and also be a resource to policymakers and the media when they're looking to answer sort of the kind of questions that popped up over the summer.
And I guess I'll throw out to one of you guys. I mean, is the pure marketplace model something worth continuing to strive for, or should we just embrace perhaps more of a hybrid or balance sheet, or say, okay, 1 year we might be a marketplace, 1 year we might be a balance sheet, kind of depending on what conditions are?
Can everybody hear me? So I have a pretty strong point of view about this, and I think that we're looking at this a little bit backwards. We should let the marketplace determine what the definition of marketplace lending is, right? Because what have we learned over the last 6, 12, 18 months? What we've learned is that all of these platforms more or less originate assets the same way. A combination of online, direct mail, partnership, you name it, we're all doing it in some form or fashion. My guess is, for those who consider themselves to be true online lenders, most folks, no more than 50% of their business is originated online. The other thing that's happening here is there's convergence around how we all originate assets, and, painfully for some, the realization that there's convergence around how we should be funding these assets. If we start off trying to define ourselves or limit ourselves as companies that are only going to fund themselves up to 70% or some percent through a pure marketplace, then we're not letting the real marketplace, the capital markets, right, the ebb and flow of capital, the impact of interest rates, determine exactly how our businesses should be funded and defined. I prefer a term that sounds more like innovative lending, right? We're all being much more innovative, and that seeks to come up with a way, there's kind of a common thread with that. If we try to force ourselves to define ourselves in a way which somehow limits how we should be originating assets, or how we should be funding those assets, and how we should be managing risk, we're going to end up continuing to deal with the challenges that we have faced as an industry over these last 12 months.
Yeah, I kind of agree with Glenn in terms of, like, does it really matter, what the definition is? I mean, I think certainly in the UK we go at pains to sort of define what peer-to-peer is, which is sort of what it's defined as over there. But at the end of the day, we're trying to create on the investor side a platform where you give access to your origination to investors, to allow them to gain a yield, which is very difficult in the current environment. And then on the borrower side, just give a better user experience. So I think we're a hybrid model, and we've found that is a way that allows us to make money. So we're a profitable business, which I think is sort of where some of the platforms that perhaps are really religious about being a marketplace do struggle. But yeah, at the end of the day, I'm not sure a true definition matters that much.
Yeah, I mean, to be clear, that 70%, was very closely tied to some of the questions that were popping up about a marketplace and trying to sort of make sure that there's a voice on behalf of marketplaces. But I think that, as we consider these operating standards, I think that's going to drop to zero, because I think those aren't the issues in Washington that really matter. What really matters are issues like digital redlining and proving that your algorithms don't discriminate, and it's issues around data standardization that we heard earlier this morning, and making sure that this industry can really grow and thrive, depending on how the capital markets sort of whichever way they blow.
Yeah, I would just add, I think sort of the broader lesson really from our perspective is to achieve a diversity of funding. And we can argue about which model is better, or if it's a hybrid, or however you want to look at that. But the reality is that these platforms need to fund by acquiring borrowers, but also by acquiring investors. And we view that acquisition of the investor in the same way as the borrower side, in that there has to be a diversity of channel. And so whether that's retail capital directly onto the platform, retail capital through intermediaries, or institutional capital, and we can separate that into banks, hedge funds, other types of investors. At the end of the day, it gets back to driving that diversification.
So, in that answer, I think that you hit on another kind of key topic, which is the sort of reemergence of retail as an important part of this industry. I think after a few years where there was a lot of focus on building up the institutional side of these businesses, we've seen a number of people get into sort of captive retail platforms. We've seen, I think, a renewed effort to get other retail kind of channels engaged in the industry, and a few tools to do that. But at the same time, we've also seen some real questions about the, or at least if I'm a retail investor, I probably have a lot more questions about my portfolio this year than I did previous years, asking, does the platform have my best interest at heart when it allocates loans to me? Are my returns going to be affected when the platforms have to adjust their rates because now I'm sitting on sort of off the run loans that aren't being valued the same way? So I guess as we seek diversification of funding and we look for that retail pocket that maybe, I guess, and I don't know if there's, I guess the evidence is good that it's more permanent maybe than institutional capital, but I don't know who wants to take this sort of the first stab at this, but do we have a real problem with retail? Are we looking to that as a solution, but perhaps underestimating the challenge of really making retail a permanent part of this market?
I mean, I'll tackle that quickly. I think retail investors are incredibly important for the reasons you described. I think the history of pure wholesale funded non-bank financing companies through crises has been challenged at times. So it's an important part of the funding model. And I think retail investors don't have a lot of places to go if they're seeking yield. I mean, I can make a pretty strong argument that a diversified portfolio of marketplace loans is a better investment than a high yield ETF, high yield bond ETF. I don't know, people might disagree with me, but took a long time for to go from the inception of high yield bonds to a real traded ETF. But I think retail investors are going to continue to look for opportunities for yield, and this is one of those asset classes where they can get it.
Yeah, I would just add, we think about retail in really two different silos. One is the retail customer that comes directly to the site and sets up an account. And there are clear challenges around acquiring that customer and providing them with the proper analytics to understand their portfolio. We have recently released some new execution tools and some analytics to help the investor in that endeavor. But I think there are opportunities in the indirect retail channel. So through intermediaries or creating a new product structure that allows for exposure to the product without having to select individual assets. That for us is what we believe is the real opportunity in retail and a much easier way to bring a broader universe of investors to the product.
Yeah, I mean, I think retail is a very important part of a funding base, and I think, like you say, there is evidence to suggest it's a sort of a stickier funding base to build a business from. I think so. The regulatory environment in the UK is very different to here in the US, but in the UK you can take retail money quite freely. There's a regulatory regime in place, and it's very easy, I would say, to take retail money. I think the longer term challenge with that is really whether investors understand what they're investing in, and I think there seems to be a slight shift in thinking around that, and actually questioning whether it looks really great when someone goes to these websites and it looks and feels like they're putting money in a bank account. And I just wonder if the average man on the street actually always understands the difference. And they're chasing yield, but I'm not sure there's a full understanding of necessary perhaps the additional risk that they're taking on board.
And do you feel like the industry has done enough to assure people that both the returns are what they appear to be, as well as questions about, okay, well, when you build those tools and things like that, are you getting the loans that you intended? Has enough been done to sort of address some of those concerns, or do we need more intermediaries or even greater transparency and things like that to make sure that retail can continue to feel good about this, or is this going to be? Do you think we're heading in the direction where this is marketed as something that is a kind of mostly for sophisticated people? It's something that you really need to understand first, or does it aim to be like a truly kind of broad retail product?
Yeah. What I would say to that is this, and that is that in order for it to truly work in retail, I mean, I love the idea that Prosper is taking. I think that's a brilliant approach, and I think what's really going to make that work, though, is the development of an exchange and the standardization of information. So if folks get a chance to catch up with Bill Illman, who is around here someplace, who's leading the charge at Orchard and setting up the Orchard X platform, that kind of price awareness, information standardization, the ability to see where bid asks are, real true transparency around pricing and consistency in terms of the way that information is presented is going to be key to any retail strategy. Institutional as well, certainly, but most importantly in the case of retail.
I just think the gatekeepers are new. I mean, millennials, are not wedded to their bank account or leaving their money with their bank account. We've seen that with Wealthfront, Betterment, and all these other places that they're going away from their sort of core, financial institution. So I think the key is making sure that the industry is making, a real pitch that this is a real asset class, and, getting the right standardization around the product that gives, all the different gatekeepers across the spectrum that kind of comfort.
So both of you guys just raised what I think is another kind of big question that's come up this year, is the role of gatekeepers and of exchanges. And I know that there are a lot of folks in this room, working on being some kind of intermediary, whether that's on the returns side, analyzing that, standardizing that, whether that's on the origination side, making sure that the product that you're buying looks similar. And I guess part of what that raises then is maybe what is the role of the sort of the platform as a business then? If you've got an intermediary who is kind of on both sides, right, on the loans coming in and on the loans going out, obviously there are, other parties that help find borrowers. So I guess what is the value add, or what is the role of the platform in a market where you do have so many intermediaries and gatekeepers? Is it that capital markets function, bringing in that mix of retail institutional? Is it just purely on the underwriting side, and have people done enough to really innovate in underwriting to justify? I guess I'm wondering maybe what after this year people think is really the heart of what is the value and importance of that platform that isn't just simply like a place where everyone kind of meets up and all those different intermediaries sort of exchange information and then move on.
I think it depends on the asset class and the platform. So for us, we're a mortgage lender. We see the true value long term as originating online. So the average mortgage in the UK takes 3 months. There's no mainstream lender that will take an application online. And whilst there's banks talking and certainly thinking about not automating the underwriting, but sort of being tech enabled, they're very far behind in that. So I think for us, the asset class for us sees that the true value long term will be on the origination and underwriting.
Yeah, I would add, I think so. The value proposition for us is fairly clear. For the borrower, it's an opportunity to get financing at a rate that, broadly speaking, is significantly lower than the credit card. So today, rates on the Prosper platform are around 15% on average. Credit card rates in the United States are somewhere between 18 and 19%. So there's a relatively large financial arbitrage opportunity for the borrower. Match that with an experience in accessing the credit, which is significantly better than other ways in which you might access credit. And then on the investor side, it's an opportunity to get assets that have historically sat on the bank's balance sheet, which are now available through these platforms. And we're talking about high-yielding, monthly paying assets. So the value proposition, I think, is still relatively clear. But the question around what these platforms are supposed to be doing, well, I don't think it's that simple. I think these are actually relatively complicated businesses. It's not simple to create equilibrium having two sides of supply and demand. And so there's a lot of sophistication around the marketing that's required to attract borrowers. There's a lot of work, obviously, that goes into attracting capital to the platforms. And there's everything in between, which is the underwriting, the operations, and the servicing. And all those things are not simple. And so, I think these are actually fairly complicated businesses that can't simply be defined by one aspect of the business. To make them work requires a confluence of success in a number of different areas of operation.
Yeah, what I would add to that is just, I agree it is incredibly complex, but like virtually any business anywhere in the world, whether it's putting together conferences like this or manufacturing microphones, it comes down to two things: cost of acquisition and lifetime value of customer. If you're really, really good at marketing and you have an amazing user experience, you're going to attract more customers at a better rate. So I'm thinking about this from the perspective of a shareholder in the company, right? I think it's pretty clear the value that we bring to borrowers and to investors. But for shareholders, it's about, do you have the ability to drive down cost of acquisition, significant pain point in this space, and what's your lifetime value of customer? And so everything comes back to that. Credibly, if you talk to anybody in our company, 140 different people, they know that anything we ever do, anything we ever talk about, any initiative that we invest in is designed to drive one or both of those two things. And so that means managing risk well. Really at the core, it means managing risk really well and acquiring customers well. If you do those two things, because you got to kind of bring it down to something that's easy to digest and you can scribble on the back of a business card, then you're going to create a lot of value, not just for shareholders, but for borrowers and lenders.
And
investors.
I think policymakers see the value proposition that Eric just, one of the biggest things that protects the sector from some sort of, regulation that would, dramatically transform, or alter the overall course of this sector is when they hear just how much ordinary people are saving. and then when they see that there are also ordinary people who are benefiting on the investor side, policymakers are many things, but they're often cautious to disrupt something that works for ordinary people.
So that's focusing on that the thing that preserves the industry is that offering, right? That we're saving you money versus other forms of credit. This year though we've seen rates rise across the industry. And we've also seen people sort of narrow the credit, kind of shrink the credit boxes that they lend to, right? And in part that was kind of a defensive maneuver because the capital markets were backed up, right? And they were saying, okay, well, we want to narrow ourselves to this type of credit. So which I suppose on the one hand shows that there is a marketplace aspect to this, but on the other hand maybe cuts against that aspect of it, that the delta between what you're going to pay on an online loan versus an equivalent credit card or other product has narrowed a little bit. And I guess does everyone have confidence that that in an even worse cycle that will continue, that there will continue to be like a sort of a positive benefit to online lending versus other forms of credit? Like have we? Or should we still be confident in that?
I mean, I think that's one of the things we're going to be working on at the MLA is to really try to hammer home just how much you save in an installment product compared to carrying a high credit card balance. I mean, just on the, not forgetting the business side, but just talking about the personal loan side. Because I think right now, at least if that huge survey that Lending Club just put out is any indicator, there's enormous savings for ordinary people. And so I think it would take a pretty dramatic change in the environment for this product to still not be a cost-effective option for your average person.
Yeah, but it's not just about pricing though as well. It's sort of access to finance through an online medium. So yeah, I think it's broader than just the pricing because that can vary.
Yeah, the other point, I think there's a structural element here, which is that credit card rates are tied to the risk-free rate. So as we move through a cycle, the risk-free rate is likely to rise. Credit card rates will rise. That will give the platforms the room to raise rate as well.
And to Christian's point, it is about access. And we're talking a lot here about prime and super prime customers. But there's a significantly larger market of folks who just miss being eligible at the bank level. I would argue that the pricing is a bit less sensitive there, and the value that's created by simply making that capital available is enormous.
And do you think that the marketplace model can work for that part of the credit spectrum? I don't know if we've really seen yet anybody on a large scale really go after that part of the credit spectrum using like a hybrid. Everyone there seems to be a balance sheet lender of some kind. So,
well, there's an amazing company out there called Can Capital. I was the CEO of Can Capital for 12 years, which continues to generate incredibly strong earnings year over year. The company's been profitable every year. It wants to be profitable. It's generating well north of $1 billion of small business loans, which is a lot in the small business space. So that's a perfect example of a company that has figured out exactly how to get capital into the hands of folks who typically have a difficult time with it. Now, they were born as a balance sheet company, which I think gets your mind right about managing risk. They have securitized. They haven't yet sold any whole loans, but that's certainly an option. And so I think it's a rare example, but a really solid example of how that could work when you focus on managing risk really well and you prioritize the importance of profitability.
And Can's been around for a long time, right? So it also shows the importance of time and longevity too, right? I mean, Can has been at this since it launched in the sort of mid to late 90s, right? So
That's right.
Maybe it just takes a long time to get that balance right.
Well,
or a long time as a balance sheet lender, and then you move into that.
That's right. But what I would say is this: it doesn't have to take that long today. It took that long for us at Can because we were the only guys doing what we were doing. And so, I didn't have an orchard that I could reach out to. There were only 2 banks in the United States who would lend us money in our early days. There was, the notion, we were collecting big data before it was sexy to call it big data. We were developing our own data scientists before you could actually hire data scientists. But the whole ecosystem that has evolved and that's available today is really, a significant accelerator for businesses. And, you can start something and build to scale and have the kind of access that it took us years and years and years to develop in a really, really short period of time, which is what makes it really exciting to be where we are today. And the other thing I'll just say is, because I think the topic of this conference is, in defense of online lending, we talk about the gatekeepers and the roles that they play. That demonstrates a serious, level of what I would call kind of healing and restorative power, right? That these are emerging because the industry needs it. These are emerging because there's a value proposition. These gatekeepers and exchanges are emerging because they solve a problem that we as an industry came up against, and we are able to, in effect, self-correct as an ecosystem and as an industry. And it's a very powerful sign for where we're going.
So we have a question here from the audience. Somebody's picking on Nat here, so I'll go ahead and they ask, anonymous. So that tells you the direction it's going. Will the MLA soon have balance sheet-based direct lending platforms as members?
Yeah, I expect by January that will be the case.
So you'll drop the 70% sort of threshold?
That's the plan.
And was that always in the vision, or is that something that you guys have modified?
I think it was always one of those items that was helpful as you try to stand up a group. It's hard to kind of agree to how you formulate a group, and that was one way to just keep the bodies in the room as you were starting small. Now I think the goal, and especially just in light of the way the market is developed in the U.S., again, as I said, the issues that the industry needs to prove its value to policymakers aren't about whether you're a marketplace or a balance sheet lender. They're about these other issues that I mentioned, and I think that's what the MLA is going to be doing. And I think people on the Hill, members of Congress are still using the word fintech interchangeably with marketplace lending. I mean, there is just a ton of education to do on what this sector, in the broad context, not not a marketplace platform versus a balance sheet, but just what this sector is really doing. And the Treasury Department is using the word marketplace lending to define a pretty broad swath of industry. And so I think we want to kind of get that group to coalesce.
I would just add to that, and that is, I'm thrilled to hear that, because words do matter. OnDeck was seemingly vilified because they were changing the mix of loans that they held on balance sheet versus sold in their marketplace. The fact is that is really smart and astute balance sheet management. You should have 2 or 3 or 4 different ways of financing your business, and you should have the ability to navigate amongst those 3, 4, or 5 different ways of financing your business. It's smart, and not every business has the ability to generate or to have access to 4 or 5 different ways of financing their business. So by making that kind of a change and kind of, it eliminates this perception that somehow how we finance the business should define who we are.
Yeah. Any questions from the audience?
So I guess maybe we don't have a ton of time left. So maybe let's maybe get back a little bit circle back to the idea of defensive online lending. Are there, there are perhaps some things that have emerged this year that suggest that there are difficulties in online lending, right? That is, kind of collecting customers through web-based channels. Everyone's had, we've heard of a number of kind of bad channels, that people have had to shut down. There's been questions about the adverse selection of people who can, come in online and looking for loans and things like that. Do we think that also kind of needs some rethinking, or perhaps maybe you guys think that it's been a little bit overstated, that there's something different about lending to people online than there is seeing people come into a branch, or I guess maybe online, but knowing them through some other channel, right? Because they have a checking account with you or something. So I guess maybe the question of only finding borrowers online, them coming to you, or maybe you sending them mail. Is that a model that has shown to be robust this year, or are there things that need to change about that as well?
I mean, I think the online model allows for greater use of technology in the way you interact with your customer. So, direct ACH and direct deposit, as an option or a default option, is probably more likely. I'm just, using a hypothesis than when you walk into a branch and sign up for something. And I think at the rate of branch closures we have around this country, I don't see anything getting in the way of online lending.
So I don't think much has changed from our perspective in terms of our ability to source the right customer. Clearly, these businesses are evolving over time, and the underwriting evolves over time, and we make adjustments as we move through the cycle. And candidly, I think that is actually one of the benefits of online lending, is the agility with which these businesses can adjust to a changing environment, to changing pricing environments, to changing underlying customer characteristics. So I actually see it as quite a big advantage over traditional methods of underwriting customers.
I think my red light is blinking, so unless anybody else has any pressing questions, guys, thank you for taking some tough questions and defending online lending. Thanks, everybody. Have a great day.